What is a credit default swap? A credit default swap is essentially a financial contract between two parties. Think of it like an insurance policy, but instead of covering your car or house, it's designed to protect investors against the risk of a company or country defaulting on its debt. One party pays a regular premium, and in return, the other party agrees to compensate them if the borrower defaults. How CDS works? Let's simplify this with an example. Imagine you've invested in a company's bonds, but you're worried they might default on their debt. You can buy a CDS from a financial institution. You pay them a regular fee, and if the company defaults, the institution will compensate you for your loss. CDS in India. In India, the credit default swap market is relatively young but growing steadily. It was introduced in 2011 by the Reserve Bank of India to help deepen the corporate bond market and allow investors to hedge their risks. Currently, Indian CDS contracts primarily involve corporate bonds and government securities. According to RBI guidelines, only certain types of participants can deal in CDS. These include commercial banks, primary dealers, and qualified institutional buyers. Retail investors don't directly participate, but they can benefit indirectly if they invest through mutual funds or institutions that use CDS. The risks and benefits of CDS. So why would investors use a CDS? Here are some key benefits. Risk management. CDS allows investors to hedge against the risk of default. Liquidity. CDS can increase market liquidity by allowing investors to transfer credit risk. Price discovery. CDS spreads can give insights into the perceived risk of a company or country defaulting. But it's not all sunshine and rainbows. There are risks, too. Counterparty risk. If the seller of the CDS can't pay in case of a default, the protection buyer is left exposed. Market complexity. The CDS market can be opaque, with pricing not always reflecting the underlying risk accurately. Moral hazard. If CDS are too widely available, companies might take on excessive risk, knowing they're insured. As India's financial markets evolve, the role of CDS is likely to expand. With the government and RBI encouraging deeper bond markets, more investors may start using CDS as a tool for managing risk. However, it's important to note that in India, the CDS market is still in a developmental stage. Increased transparency, better regulatory frameworks, and growing awareness will be key for its success. So, that's a quick overview of credit default swaps in India. If you're in the finance world, CDS can be a valuable tool for managing credit risk. However, like any financial instrument, it's important to understand the risks and regulations before jumping in. Got any questions about CDS? Drop them in the comments below, and don't forget to like and subscribe for more insights into the financial world. Until next time, stay informed and invest wisely.